Hello traders, hello traders. The title of the video is Elliott wave trader explains fifth wave extensions at 161.8% Fibonacci extension. All right. So as I said to trader before, all right, according to the Elliott wave rules, if the first and the third Elliott waves are not extended, apologies to traders, there is a high chance that the fifth wave will be extended. So we know that the impulse wave can be extended, talking about the first, the third, and the fifth wave. Sometimes it's quite easy to predict or to forecast that the fifth wave has more chance to be extended when the first and the third wave are not extended. But take it from me, all right? Though the rules say that the first and third wave, for traders that are following us at 24elliottwave.com, remember this. If the third wave is a normal third wave, very often we also see that the fifth wave oh, my voice, my apologies to traders, I have a cough at the moment, so bear with me, please. The fifth wave can be extended. Have I made myself clear? So the general rule, okay, talking about Elliott wave principle, when the first and the third wave are not extended, all right, when the first two impulse waves are not extended, first and third wave are not extended, there is a high chance that the fifth wave can be extended. All right, but this is not, okay, an exact science. So don't go around thinking that, oh, the first wave was not extended, the third wave was not extended, definitely the fifth wave will be extended. There's nothing like guarantee or definitely in the financial market. It can be extended. It has a high chance to be extended. There's a high probability that it will be extended. And the fifth wave will not be extended if there are no fundamental reason for it to be extended. So the market sentiment and the fundamental will help the fifth wave to be extended. So don't be surprised. Sometimes you may see, oh, George, you see the first wave is not extended, the third wave is not extended. Now the fifth wave is not also extended. What are you going to do about that? Right? Fundamental and market sentiment will help the fifth wave to be extended. So now going to our main topic today, Elliott wave trader explain fifth wave extension at 161.8% Fibonacci extension level. Very, very important point. All right. So when the fifth wave is completed and the second wave is completed and the third wave is underway, we apply Fibonacci extension to the first wave. Why do we do that? Because the normal third wave usually will stop at which level? At 161.8% Fibonacci extension level of the first wave. We know that. We all know that because it's the theory. All right? That's the level that we are watching. So traders say, oh, beginning of the third wave, I want to be part of it. See? So here they were thinking that that's the end of the third wave, it pushed it a bit up. So if the third wave stop at 138.2% level, it's a normal third wave. If we go beyond that level, it's an extended third wave. All right, that's the theory. I'm going to say something that is going to shock you, talking about this video, this trading video that I'm talking about practical Elliott wave trading tips and tricks. All right, after going into, all right, the ring with other Elliott wave traders, I have discovered that sometime you see it. Remember this. Don't forget it, my friend. Promise me that you will never forget that. Sometimes you will notice that the third wave, instead of stopping exactly at 161.8% Fibonacci extension level of the first wave, it will stop between the 161.8% Fibonacci extension level and the 261.8% Fibonacci extension level. Will you promise me that? This is the case here. And when you see that, sometimes you see will stop exactly at the midpoint. You see the median line between the 261.8% and the 161.8% level. But when it happens like this, you will draw your warning line, which is this line here. You say, all right, George, the third wave can still be extended. You remember that. You put that into your mind. You know that, okay, though it's there for now, I'm calling it, I'm labeling it. At that point in time, third wave, I put that warning line there. It can still be extended. In fact, the fifth minor wave of the third wave itself can be extended. Do you know that? Yeah. So you put it there, one step at a time. But what I want you to understand, this is a very, very, very interesting scenario. This scenario that is happening here is unique. You see, first wave, second wave, and then you put your 161.8% level and your 261.8% level, and the midpoint is there. And the third wave will stop exactly here. I don't know why. Sometimes it does. Sometimes it does not. Sometimes it will be extended more. But when you see that, just draw a line there. Or if you see your third wave stopping, like you see came in here, you say, all right, this is the end of the third wave. And you put a line there. Remember the median line between the 261.8 and the 161.8%. This is very, very interesting. When this is not Elliott wave principle, this is not Elliott wave rule, this is a personal observation that I have made. After looking at the chart many times, I have noticed that, all right? Have you noticed the same thing? That when the third wave is stopped at the midpoint between the 261.8% level and the 161.8% Fibonacci extension level of the first wave, and the fourth wave pull back to retest that 161.8% level, there is a high chance that the fifth wave will be extended. This is a beautiful example here. Was he extended? Yes, he was. The fifth wave was extended. Why? All right. I will say to you, if you ask that question, I will say to you, ask traders that have already subscribed to Day Pro Traders YouTube channel. The reason is the 161.8% Fibonacci extension level is a breakout Fibonacci extension level. Here we are. The fourth wave is ending on top of that breakout Fibonacci extension level. So what has happened? The third wave breaks above the 161.8% level, and the fourth wave retests it. When the third wave breaks above the 161.8% level, and the fourth wave retests it, okay, the 161.8% Fibonacci extension level of the first wave, there is a high chance that the fifth wave will be extended. Now, some trader will say, Joe, you just say that anytime, all right? The third wave breaks above the 138.2% level, and the fourth wave retest it, definitely, by all means, all right, the fifth wave will be extended. No, that's not what I said. That's not what I said. I said there is a high chance, high probability, that if the third wave breaks above 161.8% level, and the fourth wave retests it as it did here, there is a high probability that the fifth wave will be extended. If that is the case, remember that the fifth wave will not be extended if the market sentiment is still not bullish, or okay, the fundamentals are not solid, talking about the financial instrument that we are trading. The financial instrument that we are trading today is ASML holding blah 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 blah. It's too difficult for me to say. The EPIC is ASML, Alpha Sierra Mike Lima. This financial instrument is listed on the S&P 500 belonging to the technology sector. So look out for the third wave that is ending just a little bit above the 161.8% Fibonacci extension level on the first wave. Don't get carried away. Don't assume anything. Just understand that it's possible that if the fourth wave retests, okay, the 161.8% level, the fifth wave may be extended. But don't also forget, this is very, very important because I'm speaking to you as an adult. Don't forget that anytime we call something third wave, we draw that warning line. Why, as the price going above what you were calling a third wave at that point, that move out can also be portion of the extension of the third wave. All right? So don't get carried away. Do all the verification. Understand that this session here can also form a portion of the third wave itself. But as it's pulling back like this, you want to remember that the next move is likely to be extended, provided that the market sentiment is bullish, talking about bullish trend, or it's bearish, talking about bearish trend, all right? And the fundamentals are solid, talking about bullish fifth wave, and fundamental are deteriorating, or the fundamental have top, talking about bearish financial instrument. All right, this is it. Very simple, but also powerful. Look at that. See, look at the stochastic. Beautiful. It's a nice stochastic part here. Stochastic form a double bottom pattern here. The price also form a double bottom. This is a stochastic confirmation. Did I say that a double bottom is a validation of a support level? Yes, if the common center line is broken here. Look at that. Stochastic confirmation, double bottom, price retesting, moving average 50. Look at that. That's a moving average 50. The intersection between any moving averages and a horizontal trend line is also what? A hot spot trend. Look at that. And the common center is broken. What you need to do, you will implement at this point in time a different time frame trading method. What will be your first target? The first nearer resistance level. Did people take profit there? Yeah, they did. A pullback to retest the moving average 20. What's a moving average? 17. What's going on here? What? You see now? Okay. Now some traders understand why I'm laughing. Okay. And then, so this was your first set out targets there, pull back here, another after this one. See, so you got to break it above this high, so you'll be entering the trend above this high here. It's not easy here. This one touchy here. After that candlestick, but this one is closed because the common center is broken. If you didn't enter here, now you have to buy above the high of that. What's your next target? 261. Did people take profit? You see, they did. They did. All right. This is a nice reversal here. Why this one is a nice reversal here? Because the minimum condition is fulfilled. Look at that. The common central line at least was broken. So in fact, I recorded a video today when we were talking about how to short stocks during the fifth Elliott wave. Have you watched that video? Watch it. And look at the Fibonacci extension, 361. What are the Fibonacci breakout zones? You don't know. Subscribe to Day Pro Traders YouTube channel and watch every video about Fibonacci trading. 161.8, 261.8, 361.8, 461. Any Fibonacci extension containing 61.8 is what? Fibonacci extension breakout zone. Look, here it is. So what has happened? Why this one is very interesting, because this is a breakout zone, yes or no? 361.8. Okay? Understand this. So it breaks above and retest. You say, Joe, you said that Oh, that's a high probability trading setup. You'll be wondering. Then I will ask you, why then all this shadow here? Somebody's selling here. Be careful. GD level 2 trading. Why all this shadow here? So now it makes a bold test. Okay, you managed to buy, and it went up a bit. Okay, it went up a bit. So if you want to know the target, you apply. See, 438 Fibonacci extension level of what? The first wave. What is the 438? It's a reversal zone. 138, 238, 338, 438% Fibonacci extension level. So 438.2, 338.2%, 238.2%, 138.2%, but don't use 0.2, I use 0.0. 438.0, as you can see. 0.0, all right? Okay. 138.0, reversal zone. All right? So we want to keep it very short. It's just a very short video. Is it short enough for you? Elliott trader explains a fifth wave extension at 161.8% Fibonacci extension level. Fifth wave begins an extension usually at 161.8% Fibonacci extension level or the first wave. If we have a normal third wave or the third wave has ended at the midpoint between the 161.8 and the 261.8% Fibonacci extension level of the first wave, one should not be carried away. The third wave can still be extended one step at a time, but if the fourth wave is retesting the 161.8% level, one should think that there is a high probability that the next impulse wave, was it an impulse wave, whether you call it fifth wave or a minor wave or the third wave, okay, the next impulse wave is likely to be extended provided that the market sentiment is bullish and the fundamentals are solid, meaning that the S&P 500 itself was bullish. Market sentiment, talking market sentiment, the S&P 500 stay bullish, all right, it's not topping up, and the fundamental of this stock itself is also bullish. We can expect that the next impulse wave is likely to be connected. In this case, it was a beautiful setup. We have a stochastic, slow stochastic confirmation. I talk about that at 2-4 stock trader. You can YouTube search that video, a very popular video. Stochastic confirmation. YouTube search it, all right? Confirmation of a double bottom chart pattern. So this we conclude our discussion today about the Elliott trader. Explain fifth wave extension at 161.8% Fibonacci extension. If this video has been truly useful to you, you say, yes, George, you have done a very good job for the first time in your life with your funny accent, and like this one, please give us the thumbs up. If you say, George, well, you try your best to impress me, but I'm not impressed at all, please mark it down. But if you say, George, what do you mean by not impressed? I'm very impressed. This is an essential tutorial. Feel free to share with your friend on Google+, Twitter, Facebook, and Tumblr. I really appreciate traders that are sharing our video, and I say to those traders, you are special beings, alright? Sometimes I post video first on Facebook. My Facebook page is stochastic-MACD. Follow us on Facebook too. Sometimes I post my video first on YouTube. My YouTube channel is 24 Elliott Waves, digit 2 Elliott Waves in plural. Subscribe to them and be sure to click on the notification bell so anytime I post a video, you will be the first person to be notified. Until the next time, enjoy yourself and be very happy. We are the TSTW24 traders talking about Elliott wave trader. Explain fifth wave extension at 161.8% Fibonacci extension. If you want to learn more about fifth wave extension or fifth wave trading, go to www.24elliottwaves.com. Happy trading to you all, and I will speak to you soon. Thank you for watching.